Enseguida seguimos analizando el entorno de inflación, el entorno que nos dibujan los bancos centrales, pero antes un par de avances de lo que podría venir de la mano del Fondo Monetario Internacional. Hemos visto esta semana rebaja de previsiones del Banco Mundial, rebaja de previsiones de la OCDE y ahora algunos portavoces del Fondo Monetario Internacional están diciendo, reconociendo que el crecimiento mundial va a desacelerarse aún más y que algunos países podrían entrar en recesión. El FMI reconoce que que prevé rebajar su previsión de abril sobre el crecimiento económico mundial al 3,6% en sus proyecciones del mes de julio. Así que ojo, porque seguimos viendo cascada de revisión a la baja de previsiones económicas. Y ahora sí, seguimos con la inflación, seguimos con los mercados, con la renta fija y sobre todo con la mirada puesta en el crédito. Nos acompaña Pierre Verlé, responsable de crédito de Carmignac. Pierre, hello, good afternoon. Pierre, can you hear me?
I can hear you, yes, but not perfectly, to be honest.
Okay, I'm trying to be clear, so you just can hear me well. First question, if you are okay. Central banks and inflation week in Europe and the United States. What credit prospects and opportunities do you see in this inflationary environment?
Yeah, I mean, it's a very topical question. Clearly, 2022 is the year when the world, and not only the credit markets, rediscovered what inflation meant, what borders meant. And even before the war in Ukraine, we had the comeback of inflation in the first couple of months of the year. And then, you know, with the COVID and the lockdowns in parts of in big parts of China, the reopening on demand, and more importantly, the impact on food and energy that the war in Ukraine has, we rediscovered inflation, and it limits the ability of central bankers to intervene. And the big question for most investors is, you know, what to do with their savings in this inflationary environment. It has had a huge impact, you know, this rising cost of capital, because what we're talking about is simply, you know, a rising cost of capital elsewhere, which is, by the way, very healthy. This increased cost of capital has had big impact on valuation of existing assets, but the very good news is that it increases massively the rates, the yields that investors can achieve when they deploy capital right now. And credit offers, in my view, fantastic opportunities in terms of if you look at things, you know, just on average, the investment grade yield in euro today is where the high yield, so the junk bonds yield were last summer. The high yields are close to 6%, and what it hides is a lot of dispersion. And there are plenty of opportunities in credit markets to defend a portfolio against inflation right now. There are plenty of opportunities created by this rising cost of capital, which actually benefits to savers who deploy their cash in credit right now. But having said that, one has to be very careful about the selection of credit, because with an increased cost of capital goes the increased default rate. So you have to pick the right bonds, but I think we are coming back to a bond picking environment finally.
Mm-hmm. The European Central Bank has cleared today the path for a 25 basis points hike rates in July, and we are waiting tomorrow for the CPI in United States and the next week for the Federal Reserve meeting.
Yes, I think the game for all the for those two central banks is to continue to raise the cost of capital to fight inflation without breaking the market. And it's an important path. They need markets to continue functioning if they want their policies to have some impact, and they don't want to break the economy. But they are very happy with what I mentioned earlier, a higher cost of capital. One has to remember that credit markets don't allocate capital efficiently without the fear of default. So we have inflation, which limits the ability of central bankers to react and to save financial markets the way they've been doing for more than 10 years. They will continue to hike, in my view, and to reduce their purchase of assets as long as markets are not broken. And this is essentially what we've been seeing over the last few weeks or months. They seem to set the bar, and so far it's working to the limit where markets become discriminating, as they should be. You know, the high yield markets are open; they are not wide open. The volumes are much lower, but for good or decent issuers, they are open, they can refinance. And yes, we will have to live in a world with more defaults. But again, this is very healthy because we've been through a prolonged period where default rates were below let's say, the healthy level, the level which guarantees a healthy allocation of capital.
So I was asking you about the market reaction. On the last few months, we have seen heavy losses, but whoever enters the bond market now can benefit from the sharp fall in prices and yields going up. So given this context, what do you see as the outlook for fixed income in this context? Do you see it as an opportunity for investment?
Exactly, yes. The sharp drop that fixed income instruments have encountered over the year to date, losing more than 10% for even what is considered safe instruments, is actually a repricing of the yield. And what it means is, as those prices have dropped, the yield they generate has increased a lot. And today it's much easier to build a portfolio of credit instruments yielding 5-6% in a relatively, with strong businesses and strong balance sheets than it was 6 months ago. So yes, it increases a lot the return for a given risk versus a few months ago. What investors need to be wary of is the defaults. But 6 months ago, we were expecting defaults to rise as well. So you have to be careful in selecting the bonds you buy, but you can clearly build a portfolio which offer a good yield, and it's an excellent alternative against inflation, and it's an excellent alternative against many other asset classes which have also a lot of sensitivity to rates, and where you don't know how much you will get in 2 to 3 years. And that's what I love with credit, particularly, is the fact that you invest on the market sentiment, that is the yield at which you buy your bond, but provided you were right in assessing your risk, you're going to make your return based on a contract. You're going to make your return based on coupon and repayment at maturity. What it means is that you can lock in the yield when you buy, and it's extremely rare for an asset class, and this is what we love, and it's perfect for value investors. And clearly the new increased cost of capital, the new environment with higher rates and higher credit margins is much more attractive for credit investors than it was a few months ago.
And how will the backdrop of international uncertainty, supply chains and risk continue to affect this market? Are we betting on credit rather than sovereign debt?
So over year to date, we have rediscovered inflation. We have particularly, since the war in Ukraine, we have rediscovered what borders meant, the risk on supply chains, the impact on margins for issuers, the impact on their ability to source some products, but also, and certainly not least, the impact on consumer demand, because inflation is going to impact the health of the consumers. When you think that probably 25% in Western Europe of the consumers' budget is spent on energy and food, if you have sharp rises in those two items, that will impact their health and their ability to consume. But you have a rising risk, but you have a much rising yield. So you need to understand the consequences of this new environment and this rising cost of capital on your issuer. Actually, be it a national issuer, be it a sovereign issuer, or a private issuer, a corporate debt issuer. But clearly, the credit margins, what you get when you buy a credit versus a risk-free bond. So the risk-free bond in Europe is considered, the German bond is much more attractive than it has been. In terms of sovereign debt, it's more. I would distinguish the periphery and the core. It's more a view on inflation and on rates. And the lower yield you get on sovereign debt is actually a lower protection against duration and duration risk, against the risks that rates continue to rise. While in credit, you have a compensation of this risk, the duration risk, the risk that rates rise, coming from the higher carry. And I think carry is absolutely key. And I would favor carry instruments, with higher yields, higher spreads over sovereign debt instruments.
Okay, and finally, I wanted to ask you about emerging markets. What are their credit expectations?
So it's the same as for corporates. You need to distinguish in this new environment with a higher cost of capital, which, higher cost of capital, probably lower demand for debt instruments from financial markets, more geopolitical risk, and last but not least, a more expensive, a strong dollar. The strong dollar is usually a headwind for emerging markets. But having said that, you have to distinguish those benefiting from this new environment. I would say particularly for corporates, some emerging market corporates directly benefit from some higher raw material prices because they produce and export those prices. Some are actually more vulnerable because of their lower ability to access capital markets because of the stronger dollar when they are not hedged they haven't hedged their balance sheet, or when they are importers of, for example, oil or energy. And you have to energy or food, and you have also to look at the sovereign risk, because some countries will face important difficulties sourcing food and energy, which could lead to political instability. So you have to be very careful, but again, it creates great opportunities. It's at those times of dislocation, with rising yields, that you have the best opportunity. And one should not look at the asset class as a whole, but more at the opportunities, at the idiosyncratic opportunities that the dislocation creates.
Okay, Pierre Verlé from Carmignac, thank you so much for attending us. Have a nice day. It was a pleasure.
Thank you very much. It was a pleasure.